Well, hello. This is Jim Newhard, CPA. Greetings to all my friends, colleagues, clients, associates. We're winding down on 2020 and like to take a few minutes to go through some pre-year-end tax planning tips. These are issues or opportunities or landmines that might be out there that we may not have anticipated because 2020 was such a different year than we've ever had before. COVID-19 really took its toll this year. We had major legislation, Families First, the CARES Act. We have significant legislation waiting in the wings, hopefully in early 2021, to try to get us through this both health-wise and economically wise. And it is certainly a year where our tax return is going to look different than it ever has before. So let's go through some of those things. And these are keys or attributes or characteristics that should cause you to say, hey, we need to do some planning. Let's do some more analysis. And maybe we need to do some projections and some estimates so that the only surprises you have in your future are come on Christmas morning, okay? So first of all, let's start with the economic stimulus checks, those impact payments that we received earlier this year. And hopefully you did get your stimulus if you were so entitled, because they were based on tax breaks on projected income levels for 2020. Good news is not taxable income coming back to you. So not a problem to worry about. However, wages. If you changed your job this year, or maybe you lost your job because of COVID, or you took some extended time off from that job, no doubt your W-2 this year will look different than it's done in the past. The income will be different, the withholding will be different, and how those align could have a big impact come April 15th. Now, also, if you were one of the millions upon millions of Americans who collected unemployment benefits to kind of help you out through 2020, great that you had that relief. But remember, unemployment is taxable income. And most folks tend to forget to have federal withholding taken out, or they choose a very, very nominal amount or percentage. And oftentimes that's far less than the tax bracket you find yourself, and you end up owing money on that unemployment. Now, for our portfolios, interest income is going to be way down in 2020 because interest rates are depressed, and suppressed. So that's going to be a little bit less on the income side. But on the dividend side, generally, qualified dividends are taxed at a much lower, even in a zero tax rate, because it's a preferential rate depending on your income. But unqualified dividends are taxed at your highest incremental rate. Now, what makes a qualified dividend? Well, the company had to have profits. They had to have more profit than they are distributing in dividends. So if you get dividends this year, their tax bracket could be different for you, and that could really catch one off guard. Now, for those of you who own real estate and are renters, you're a landlord. No major tax replications or changes happened in 2020. However, there are some legal changes. That is to say, most governors passed legislation this year that allowed tenants to bypass several months worth of rent payments without the any kind of concern of reprisal. That is, you as the landlord couldn't evict them or take any other type of remediation action. So what you'll have is much lower income this year from rents, but still the same 12 months worth of costs and expenses, changing the bottom line. If you're self-employed, it was a truly wild and wacky year. A lot of uncertainties. Things changed. A lot of interruptions in our workflows and our revenue flows, and certainly in our cash flows. This could cause a lot of stress, and in a lot of cases for self-employed people, we tend to skip estimated payments because of how tight money is. And then we might find out all of a sudden, my goodness, we didn't pay in enough tax. We are not only going to owe, but we might even be subject to penalties for not having made those. Now, if you are a business owner and you took out the PPP loan advances or the idle disaster loans or other state or SBA sponsored opportunities, we're not 100% sure how some of those are going to affect our bottom line. And we'll talk a little bit more about that today and in future videos when we focus strictly on business aspects. Now, with regards to retirement assets, two different things to be talking about. First of all, if you're under 59 and a half, not yet the age of taking distributions without penalty, well, in 2020, they have waived the 10% penalty for taking out money out of your retirement if you're too young. This is a break. However, remember, it's still subject to federal income tax if those distributions, as well as state and local taxes as well. So be prepared for that. On the other side, older folks who are in the required minimum distribution range, that is 72 years or older, where you're required to take money out, that requirement has been released for 2020. You can forego those distributions and preserve your retirement money for future years. Now, the downside there is a lot of people take out money out of their IRAs or retirement accounts and have extra withholding taken out in order to cover other sources of income that they have. So if you didn't take those distributions this year, you didn't have those other additional taxes paid in to cover the tax implications on other sources of income. That could catch you off guard. In the world of capital gains or losses, perhaps you pulled money out of your investment portfolios and sold stocks, bonds, mutual funds for that liquidity. And if you hit it really, really well and you generated gains, that's awesome. But those gains are taxable income and you may not have had tax money paid in for them. On the other side, if you hit those low bars, the low water levels on those stock prices, and you recognize a bunch of losses in your portfolio, well, the IRS code only allows us to deduct $3,000 of losses in excess of gains for capital transactions in any 1 year. So you may not get the full benefit of those tax losses this year. With regards to charitable contributions, a couple items to be aware of anyway. First of all, if you take a standard deduction where you normally don't take those contributions separately, in 2020, they're allowing an additional above-the-line deduction for up to $300 of charitable contributions in addition to the standard deduction. Okay, it's something. Meanwhile, for those who itemize, generally we're limited on the charitable contributions that we can deduct in any 1 year. Can't exceed 50% of your total income. May or may not be something that you're all that worried about. In 2020, they've removed that cap and there are no limits. Anything that you donate to a qualified charity will be deductible in 2020. Now, with most religious services suspended for part or all of 2020 for the most part, and there have been a lot of uncertainties in our families and home lives, perhaps we find ourselves having made significantly less in charitable donations in 2020 than we usually do, than we usually want to, or that we plan to in our tax strategies for 2020, and we'll find ourselves short. So there's two strategies available. Well, one is there's still time up until December 31st to start making donations, contributions, distributing those to the charities that you care about, to accelerate this deductions before the end of the year. Another option might be to forego those, defer them to 2021. That is bunch or double up contributions in 2021 to get a much bigger bang for your buck next year, where we think we might have higher income and therefore get more benefit from those deductions. Which is the right strategy? That's something that we need to talk about and plan with. Self-employed folks, like I mentioned, if you had PPP loans and you have not gotten that SBA forgiveness, well, right now, barring the stepping in of Congress to the contrary, The IRS is taking the position that we will not be able to deduct any of the expenses that we anticipate as offsetting against those PPP loans towards forgiveness. So that could change our taxable income different than what we planned. And a financial planning tip, well, maybe you postponed or stopped your 401k contributions this year, or you weren't planning to put money into a IRA or a SEP because of how tight money was in 2020. While this preserves your liquidity individually, you miss out on the opportunity of putting money away for your future. That is a decision that can't be taken lightly, and we should evaluate it carefully. And now you got January 1 coming up for a new year, and you want to decide how you want to get jumping off into that new year as well. Finally, with millions and millions of our kids, I was going to say thousands, but it's millions of our kids are virtual learning. They're at home on laptops and computers, doing this remotely. And maybe you have kids, and maybe you have loved ones or elderly family members who are in your care that you're taking care of. And as a working parent, perhaps you don't have the capability or the ability or the flexibility to be that homeschooling parent, to be that caretaker to that relative. And perhaps you've engaged someone to come into your house to help you out, to take care, work through with your kids or with that family member, which is a terrific thing to do. However, there's a law. When you hire people to work in your home, you are probably legally obligated to withhold both federal and state payroll taxes from their payments, as if you were an employer and they're an employee. If you fail to do that, there's taxes and penalties that can be assessed with that. So all these are items. If you have them, give me a call, shoot me an email, send me a text. And let's plan for a great tax season and have a great year-end holiday.